just what is the Federal Reserve's mandate, and has it stayed in its lane? Whether or not it has, what are the actual mechanisms it uses to influence the economy? And how might those mechanisms affect today's raging inflation? Separately, is there such a thing as good stress? If so, how can you harness or even seek out such stress to grow stronger or more resilient? Finally, if over a window of, say, 3 months or a year, a certain investment falls a lot more than the so-called benchmark you're measuring it against, does that reveal it's bound to be a loser and something you should get rid of? Stay tuned for another installment of the RLS Boys' occasional Bring Your Own Topic series right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. We have a great topic for you today. I'm looking forward to go over this. We've done it once before, and we've gotten some good feedback, and I'm hoping this becomes a regular for us. Today, we've all selected our own topic that we'll discuss briefly, and we have not shared with one another what we're talking about. So hopefully there is not overlap. If there is, this will be a short episode, and we'll go over that before we jump into it. Gentlemen, how are you feeling today? How was the last week?
Adrian, how about you?
Everything's been good on my end. Excited for this episode. I love Bring Your Own Topic. Just excited to hear what you two are bringing to the table today. I know our listeners are. How you doing, Erik? I'm glad you're here. It's good to see you.
Yeah, it's been a busy 3 or 4 weeks. I've been on the road for conferences, driving up the East Coast, seeing clients, then in my Crystal Lake office. So I feel like it's just been hard to catch a breath. So this is kind of fun actually to slow down with you guys a little bit this morning and record together and hear what's on your mind. I'm looking forward to it.
Yeah, I think this is an important thing to discuss because as either the different hats we wear, right? Literally from financial planner to investment advisor to even, father, in Adrian's case, fiance, or father to Alfred, his dog, and Erik, grandfather.
The term is parent.
Parent, okay.
Like
Parent.
parent, parent
Wow.
with a dog.
All right. Parent, yes, I should be respectful and include that. And Erik, grandfather. I feel like there's so many different things, and so our listeners similarly will wear different hats, and it's different things we're thinking about that we feel are relevant. Now, I have not gone too far out on a limb for my topic of the day, which will give you guys, everyone listening and both of you, an idea of what's top of mind for me. But I feel like this year, from a market perspective, is very much, and we could say the last 20 years really, is 13, 14, very much driven by the Fed. And we are recording this on March 16th, which is when the expectation is the Fed is going to raise rates. We're recording it before the announcement. The current consensus seems to be at about a quarter point. And I thought it'd be worthwhile to discuss, one, on a really basic level, what is the Fed doing? How and why it impacts markets? So I'll just start us off, and then, gentlemen, please jump in. To me, this question starts with, well, what's the Fed's job? And you'll see a lot of debate as far as what their actual job / what their actual mandate is versus what they do. And they have a dual mandate, which means they've got to do two things: price stability, and their target is an inflation rate of 2%. So last week when the data came out with over 7%, that will show you why the Fed's got to do something. And then second is maximum sustainable unemployment. Maximum sustainable employment.
Yeah.
Excuse me. And I was going on to explain they have a target for unemployment. What unemployment is acceptable and normal in a good economy. Right now, that medium estimate is at 4.1%. So those are their two jobs: price stability and maximum sustainable employment. Gentlemen, anything to add before we explain what the rate hikes mean, what they do, and how it impacts everyone?
I think you've summarized it really well. I guess I would just hasten to add, it seems as though the formal role, the stipulated role is one thing, and what you see in terms of the practical outworkings of what they actually do, it appears that still another role is to never let the market go down. So,
Uh,
it's not in their mandate, but it sure seems like that's what they've been doing the last 13 years.
and Eric, I'm not sure, Eric or Adrian, I'm not sure if you caught what I was saying. That's why I said their stated mandate at the beginning, because I know
Right.
there's a lot left up to debate. And I also had said that the Fed's driving the market now, and sort of corrected and said, well, maybe the last 13 years, going back to
Okay, I'm with
2009.
you. All right, I'm with
on the
you.
same page with you now that we know what their mandate is, what their stated mandate is, and Eric, you've shared what a lot of people say their mandate also is, which there is data behind the fact that a healthy stock market does trickle down to GDP growth. We won't go down that path today. Let's talk about what's going on now and how it impacts the individual. So the Fed today is meeting, or they started yesterday. They're supposed to announce raising interest rates, and this is really a response to, in part, or I'd say majority of what they're doing right now is in response to higher than expected inflation. So I'm going to throw this question out to both of you. Feel free to jump in. How does the Fed raising rates impact inflation?
Adrian?
Well, that's definitely a big consideration that the Fed's looking at. I think since rates have just been so low constantly, there's just been a lot of money going in and out of the system when you also consider the amount of stimulus that's been going in. So raising interest rates is a little bit of like a hedge just to balance out the inflation, even though I think a report came out this week saying inflation wasn't as high as it was expected. So that's just something people are going to be watching.
Yeah, and that's a great explanation, a sort of macro explanation. I just want to go a little bit more detailed as to why, looking at the economics of it. So what the Fed controls is the Fed funds rate. They'll also refer to that as a target rate. The target rate is the interest rate a bank charges another bank to borrow money. So every night, banks need to have a certain amount of reserves on hand. And it's a frequent thing that they'll lend money to one another. If you've got a little extra, you lend it to another bank that has a little bit less, and that bank pays you interest overnight. When the bank has to pay higher in interest, guess who else pays a higher interest rate? Anyone with a loan, right? Any borrower. So if you raise interest rates, I think right now with what's going on with the automotive industry, that's probably the best comparison. People will tend to get a loan for a new car. You raise the interest rate, the monthly payment is up. All of a sudden, demand goes down a little bit. And there is what impacts inflation. And the car is just a good example because we've mentioned this many times on our previous episodes. But we've seen used car rates go way up, and used car prices, I'm sorry, not rates. We've seen used car prices go way up, as well as new car prices. And the big debate the Fed's dealing with is this temporary or transitory, or is this real inflation? So part of it is a supply and demand imbalance because we don't have chips, for example, that go into cars. We're not able to make as many new cars as the demand as is being demanded by the consumer. Consumers then go to used cars. All of a sudden, you've got a higher demand for used cars, and those prices go up. So when the Fed raises rates, the rate that people pay on auto loans go up, and then people might not pay as high a price because now the monthly payment is higher, or they might say, you know what, I don't need a new car now, I'll get one later. Now, I'm using cars just because I think they're a really good economic example and economics at its basics, looking at supply and demand over the last year. But this interest rate affects everything from the consumer's perspective. mortgages. There was a report that came out this morning that to me sort of seems like stating the obvious, but home builders may not sell as many houses because interest rates are going up. So people won't want to get another mortgage or qualify for as high a mortgage. All of that is because of the rates going up, that the Fed drives that. And this is all consumer stuff. The same thing impacts businesses. Businesses now have to pay more for a loan, so they may not be as inclined to invest in certain areas of their business because they need a greater rate of return than they did just prior to the Fed raising rates. They do it gradually. You hear the term 25 basis points or a quarter point. That's 0.25%. So getting a loan on a car, let's say the rate was 1% and now it's 1.25, it won't have a huge impact, but what it is signaling is that the Fed's going to continue to do this, and that really, I said it's signaling they're going to continue to do this, but how they plan to continue to do this is what is up for debate. What they're going to say after the meeting, people are going to really look closely at any change in single words to try to predict where things are going. So, gentlemen, please tell me your thoughts. Please fill in any gaps that I left in there. My goal was to explain to the average listener that doesn't follow the financial press as closely as we do why the Fed rate and the Fed meeting can impact them or impacts them so significantly, and why the market reacts so significantly.
Oh, I think it was a great explanation, and you're absolutely right. Just the raising the rate just increases the overall cost, not for those things that you finance in whatever way, and as a result slows the demand, and as a result cools off since inflation is in balance between supply and demand. Then we say too many dollars chasing too few goods and services. So if you can slow down the number of dollars that are chasing those goods and services, you take some of the price pressure off. Do you think the Fed's role, is also one of providing liquidity? They have the opportunity to raise or lower reserve requirements for banks. That also can, at the bank level, dictate whether or not, based on the number of deposits they have, what their ratios can be in terms of what they can lend. And so, they have several levers that they can use for this, but the interest rate is the one I think that people follow the most closely because it's the most easily, I think, conceptualized. And so we'll see how it goes. I will say this, going beyond just the theory, the mechanics of it and the theory, it does seem to me that right now they're not being sufficiently aggressive. I know they're concerned that they don't want to hit the brakes too hard and raise the rates too quickly, but I think they're way behind on inflation, and if they don't ramp it up, the concern I have with this whole inflationary pattern that we're in right now is that once it starts to take hold and kind of embed itself in people's expectations, then it's harder to see it just kind of naturally recede. It just can't be allowed to perpetuate. I think if we have it perpetuate at these kinds of levels for another year without real action being taken, I think that becomes a problem. And I say that knowing that Fed watchers, if they did see the Fed increase, let's say, rates by 0.5 point or 3/4 point, there would be a very powerful market reaction to that. I understand that, and I don't relish that, but I think about the short term versus the long term. The long term consequence of elevated inflation to me seems like the worst path for us, and that's why I'm hoping they'll be more aggressive about it.
Well, let me ask you then, as a follow up to that, what if you knew that raising those rates as you see as you'd like would lead to a recession? Mm-hmm. Does that change your thought? Or do you say, well, a recession's fine, it's still a recession is worth curbing inflation? Is that your stance?
Well, let's first of all define recession. So a recession is two consecutive, the formal definition that economists use of recession is two consecutive quarters of negative growth year on year from the prior year. So, or at least a smaller gross domestic product on a trailing 12-month basis for 2 quarters in a row. So, yeah, I guess I would say, depending on the depth of that recession, Roshan, yes, I wouldn't think that that's the worst thing that has ever happened. If the outcome of that is to put inflation kind of back into that 2.5% area, somewhere in there.
So you would say it's worthwhile deal with the recession and keep going.
Right, because for me, I mean, it's an economic growth question on a real basis. You've heard me say many times, listeners have heard me say many times, that I'm a big champion of wealth creation, because wealth creation, I think, is not only, it makes so much possible, particularly for the poor. I think the people who are being hit the hardest right now by the inflation, unfortunately, are the people who can least afford, have the least means in our society right now. It's one thing for the three of us to have a gallon of gas at, probably a little bit higher where you live than where I live. But, probably for you, I wouldn't be surprised if you're seeing it at the 5s at the pump, and I'm seeing it in the 4s at the pump. That's one thing for me. I don't like it, but it's not consequential. But for a lot of the people that live around, this county, that's a deal for them, because now if they're just driving a 4-wheel drive, you might say, well, they shouldn't be, or they're driving a pickup truck, or they're driving an older vehicle that's not as fuel efficient, and they've got to get here and they got to get there, and now they're paying that. They just don't have the margin to cover that. So, and you kind of do that through all things: gas, groceries, heating at home, et cetera. It just becomes really problematic for those families. So that's why I think it's probably worth getting that under control.
Well, and Erik, it just because the example you used of gas, it's worth noting they don't include food or energy in the inflation data the Fed uses. Right?
Oh, I thought they did.
No,
so I
and
personal consumption.
Yeah, they exclude that, I believe it's because the volatility is too high. I'm thinking back to '08, because I remember having conversations when gas was over $100 a barrel then during the Chinese Olympics. It was August '08, and thinking, what's the Fed? Why doesn't the Fed include it? It makes no sense. And then I remember 6 months later seeing gas down to like $40-50 a barrel, and thinking, okay, that's why they don't include it in their data point for it. So, but your point is still unchanged. I just wanted to mention the food or oil thing, that you're saying if inflation is too high, you think going through a recession is worthwhile in order to curb inflation, if that's the path necessary.
Yeah, right. Because if you say, hey, we take, let's say, just use, for example, we're winding up with the first quarter right now. So let's say you take the second quarter of 2022 and 2023, or pardon me, second quarter of 2022, the third quarter of 2022, and you compare those to the second and third quarters of 2021. And let's say you're at negative .5 point, negative 1 point in terms of GDP. Just you're only marginally down. Okay, you've met the formal requirements of a recession, but it doesn't mean that suddenly it's a depression and that the economy is just kind of spiraling downward and people are being laid off left and right. It's just not growing quite as fast. It's the growth has stalled. If that's what it takes to get us to a point of significantly slowing inflation, I think that's a fantastic trade.
Yeah, and I guess I should have defined it. So how deep a recession would be too much for you to and we don't have to use data, but if all of a sudden unemployment's going up, businesses are either slowing or closing down stores, that kind of thing, is that worth it to slow down inflation?
Well, I guess it's it's, since we're having this conversation in sort of categorical terms, I'd rather say it in sort of ordinal terms, if you know what if you know the distinction I'm trying to make here, is that in this particular sense, if let's say you tell me, hey, it's going to be decline of 10 or 15%, I'd say that's kind of bordering, that's directionally toward depression,
Yeah.
not just a recession. And I'm not for that.
Mm-hmm.
But my point is that the inflation, it seems to me, is a you can recover out of a recession, and you oftentimes do with a kind of reciprocal, what's the word I'm looking for, sort of acceleration of growth coming out of that. But it's really hard. So in other words, that's a little easier thing to fix than the problem of embedded expectations for inflation. It was extremely costly for Volcker and Reagan in 81 and 82 to deal with that. It had a very sharp cost, and so I'd like us not to get into a position where that is true again.
Yeah, and I see your point. I just ask you that question because that's what the Fed's dealing with right now, right? With and you mentioned oil prices, and I talked about how they don't use it in their data. That's accurate. However, as you said, the average consumer going to the pump, it will make a difference, and it's not just gas, right? Oil is used in production and transportation of almost everything around the world and the country. So prices for everything will go up as oil prices are higher. You've got Russia's invasion of Ukraine, which has made high inflation even worse. But the Fed's whole quandary now is raise rates and risk causing a recession, or wait it out. And I think we'll see what'll happen this afternoon. But at the beginning of the year, I remember reading a lot about like 6 to 8 rate hikes in 2022, and there was talk of March being a half a point versus a quarter point. I think we're going to see March. Powell came out last week and said he's an advocate of a quarter point, and the Fed's pretty transparent. So I think we're going to see a quarter point today. And I'd be surprised if there were more than a total of 4 rate hikes this year with the uncertainty, barring some major quick resolution with the whole Russia-Ukraine situation. So I think they've got to slow things down. I've taken up more than my ample time for my topic. Gentlemen, I'm going to summarize and just say to everyone, the whole point of going over this wasn't necessarily to speculate where they're going, although I did expect that from us today. But it's really to say the Fed mandate is to control inflation, to get us to peak employment levels, and they do this. One of their most frequently used tools are adjusting interest rates. Right now, we're talking about adjusting them up to help manage inflation, which will slow down spending across the board. And that's how the impact is felt with slowing inflation. If people they're lowering demand, so theoretically prices should stabilize to come down. And I will pass that on. Adrian, you were next with your topic for today. So you have to stand up to last time you came up with metaverse. I hope you've got something good.
That's right. That was incredible.
Yeah, I do have something good for our listeners today. So if you're kind of stressed out right now about hearing about Russia invading Ukraine, or extremely high gas prices, or Erik and Roshan talking about recession, then I have some good news for you today. There is such thing as good stress. And the scientific term for it is hormetic stressors, which are short-term stress techniques followed by recovery and restoration that can help your body and mind weather tough periods in your life. So I think Roshan's topic kind of helped lead right into mine. So I'm really excited to talk about this area and why it's important. I think it's extremely important because short periods of stress impact our bodies on a cellular and molecular level, which challenges our bodies to adapt to tough conditions or stressful moments in our life. So this can help promote and grow new neural pathways and slow effects of aging. So why is my topic important? It can help you live longer, and it can help just develop creativity. So I thought this was a really interesting topic to share with our listeners today. And I think this is really important, just having good stress in your life, or like I said, the scientific term are hormetic stressors, because it can kind of keep the biological and chemical composition of our bodies from becoming complacent. And this can just help just generate a healthy, more active lifestyle and can help you deal with more emotional strain in your future. And I think that's really important now, just especially with the amount of adversity and the things that are going on in the world right now. So this could be really important if you want to live a longer, happy retirement, or just spend more time with family, or if you're just going through a very important moment in your life. This can really kind of help you just get as prepared as possible. And it kind of seems more of like the bend, don't break mentality, where you're kind of just pushing yourself or just implementing new stuff in your life now just to kind of help out your future self. So what do you guys think about this topic before I get more into it?
My first question is,
fascinating.
did you use my topic as an example of a good or a bad stress?
I just use your topic to kind of lead to my topic in a clever way, Roshan.
Yeah, I will. So my question for you then, Adrian, is can you give examples of the good stress if I'm trying to take advantage of that and have growth in my life?
Yeah, that's a perfect question. Some areas are breathing techniques. That's a common one. Cold showers or hot saunas, I think, are popular ones. I'm not a fan of cold showers, and I haven't been in a sauna in years, but apparently those are like the top ones where you're kind of putting your body in a not normal state, where you're used to room temperature, and now you're putting your body in not extreme conditions, but a cold shower could make your body adjust. It'll elevate your heart rate going up and down, and as a way to just get your body from complacency to a form that it's not used to, I think is really the important concept here. And these, like I said, are all ways to crank your heart rate up and down and can help lead you to cope with emotional stress or just tough events in the future. Those are some of the examples there. Are you familiar with any other ones that come to mind?
I'm not. I'm trying to think of whether I've heard this before. I'd like to say I have, but the first thing that came to mind while you were describing it to me was exercise. Like just in general, that's what they say your muscle goes through. I don't know if it's formally defined as good stress, but you're stressing your muscles to help grow them when you're exercising.
And the concept is kind of like short burst of stress. So it's not necessarily like a long exercise. That's why like a cold shower, you can just pop in the shower for 5 minutes just to help like regulate your body, get your heart rate up and down. Again, it's just kind of techniques. And I think an example here might kind of help the listeners to kind of see what happened. A real life example, there was a person in their mid 30s, and they were going through a lot of events, family events. Work was extremely busy for them. So they just had a lot of stuff going on in their life. They were going to therapy. They were praying constantly. And so they looked at hormetic stressors as a way to add on to this therapy and praying that they were doing, to kind of add that other addition to their life, which ended up helping them get through the tough time they were in their life. So this is just like a little thing that you can maybe add right now that can kind of help you in the future when it comes to just like events or just tough times. It's very important. It's also important to note to listeners that you have to be careful and like seek guidance from a fitness professional or a doctor if you decide to take on more like high intensity hormonic stressors, because some techniques online can be very dangerous and sometimes controversial. So it's really important that you kind of seek guidance if you want to like crank it up a notch and really just put your body through the ringer, so to speak. So it's just a really interesting concept that people are talking about, because mental health awareness is becoming more important in our society today. Again, with the amount of trials and adversity people are facing in the world nowadays. So the connection between the mind and the body is being examined, studied more than ever before, just to find ways to improve people's overall lifestyle.
Yeah.
So when you said it, I was thinking that it was more than the physical, but I love the example of the sauna and the cold shower. So is it mostly physical stressors of some kind, or is it also is it emotional, from just the general stress of life?
Well, I think for that example I said, where that person was going through more like like a lot of events for the emotional side of it. They went to go see like a therapist. They were praying. So there's a lot of techniques. So I guess hormonic stressors do fall more on like the physical side, but it's again just I think the most important thing from this concept is kind of having a more comprehensive approach when it comes to just developing a healthier lifestyle, just adding on whatever features you can, not necessarily just taking on like going on like a 10-mile run or something. You could do something like right now that could take like 5 to 10 minutes. If you just stick with it through the week, it could kind of help you develop a better way to deal with trials or events that go on in your life, and just kind of improve you and give you that little addition that might help you move forward.
Well, it's interesting because the reason I was asking about the physical element is I just observe that, at least in myself, that sometimes sort of putting myself deliberately in a position where I don't have quite enough time to get everything done puts me in a mode, it kind of flips a switch in my brain that suddenly I go into really rapid completion of tasks. And it's sort of like the phenomenon, it's like the day before you go on a vacation. How much you get done on that day before you go on vacation. Because you're working to get everything wrapped up before you head out the door so that you can actually enjoy it and you don't leave anything that's crucial just sitting around unfinished. I find those days before a vacation or those days before a trip are my absolutely most productive days ever in terms of just the task accomplishment. So, and I also just noticed that over my career, what I once thought would be just unimaginably hard to complete or to accomplish in a day or a week or a month or whatever, now just seems like that's just routine. And so I think it's the expansion, those kinds of stresses expand your capacity, because you find, oh, what I once thought was unimaginably difficult and I would get freaked out about it, now just seems like, okay, that's what we're going to do, and you just do it, and next. And so your capacity to deal with the next greater challenge just continues to expand.
Yeah, that's a really great example. That's exactly what this is promoting, really. And like I said, the bend, don't break mentality, where if you're putting your body through these like exercises or these examples, or just moving forward, so to speak, you'll be ready in the future if like a harder task comes your way or a more stressful event comes. It's really important to kind of make sure that you're ready for it, and you just have these kind of ideas or techniques that can help you be more prepared.
Yeah, and Erik, I did just a quick Google search for your question. I was curious as well, and this, I don't know if it falls under, and Adrian, am I saying that hermetic stress? Is that the word you were using?
Hormetic stressors.
Hormetic
or stress.
So I don't know if that's a more specific category, but I just did look up types of good stress, and it says receiving a promotion, starting a new job, marriage, buying a home, having a child, taking a vacation, holiday seasons, retiring, taking educational classes. So there are a lot of things that are mental and not physical on that list.
Okay. Yeah, that's a good point, because I mean, I think, for example, just as you mentioned on that list, how many people think they're ready for marriage? And a lot of times I think people delay that. They delay marriage because they think they're not ready for it. I think the best way to get ready for marriage is to get married. I mean, I don't mean it's quite that simplistic, but sometimes you grow into that challenge. How about having children? I'm not ready to have children. Well, have a child and you'll get ready for having children really, really fast.
Yeah.
So
I remember when we had our first kid, we had Dylan, and we're sitting there and we have the baby right in the hospital room, and the nurse left, and we're like, they're just leaving us, with this baby. We took the class.
And Dylan survived it.
He did. He's almost 10. He's okay.
Yeah, and I think another important point is, like, when you go through these like life events, it could be a lot all at once. You're juggling a lot. It can be stressful. It can be up. It can be down. But the most important thing is you're just going through it and you're dealing with the best way you can. And when your body kind of it's also important to mention this concept only works if you kind of have that restoration and going back to equilibrium is the main point of it, where you're kind of bringing your body back to this constant state after going, let's just say, up and down. And that is what, Erik, you mentioned, can expand your capacity to take on more.
Yeah. Well, I think it's a great topic. 2 nights ago, 3 nights ago, I had to do an all-nighter because without boring the audience with the catalyst for this, I got a phone call that said, hey, you need to blah, blah, blah. And so I had to kind of take what would have been the entire day's next day's projects and fit it into that night. Anyway, I just got about 45 minutes of sleep that night. And last night actually was just another one of those. And I feel like, okay, I'm a little bit burned out right now, but being around you guys is just so energizing. I feel like I'm getting that mojo back. This is sort of like that recovery moment. Thank you, Adrian, for making this so chill. Now I can kind of mentally frame what we're doing here as just like recovery time for me.
I'm glad. I hope I help you get energized where you're ready to discuss your new topic and really see if you can top Roshan and my topic.
Listeners, this will certainly not top either of the last two topics. What I'm going to be talking about is investments and setting your expectations for what will happen with the different parts of your portfolio, so that you're not taken by surprise and you have the capacity to give solid long-term investments a chance to play out, and you don't sort of abort the journey prematurely. And the reason I think this is an important topic is for two reasons. Number one, mutual funds will oftentimes report their long-term compounded annual growth rates on the price of their mutual funds. But then when you compare oftentimes the average investor's actual return from using that mutual fund, you find that there's a great disparity. One such mutual fund, I'm trying to remember now, who this sort of legendary investor who had this phenomenal 15-year track record, but because there was a lot of volatility in it, a lot of people would pile into his fund sort of near it had a big giant run, and they thought this is going to be the greatest, and then it would have one of its periodic downturns, and then they would start rushing for the exits and they'd get out. And so as a result, the average investor return was actually negative in a fund that had one of the most spectacular 15-year total returns strictly on a price and reinvested dividends level of any fund that was out there. So what I want to try and offer you listeners today, and especially viewers on YouTube, because you know me, I'm a spreadsheet guy, and I can't do one of these bring your own topics without having a spreadsheet and a graph. So I've got some graphs that I'm going to share with you. So before I show the graphs, let me just set up the issue here, or the problem, or at least the question I want to look at. So I went into, just so that no one thought I was cherry picking from ridiculously heroic funds or ridiculously bad funds, I wanted to confine myself to one large fund family and make it as close to passive investment as I could. Hence, I've probably given enough clues now to say I went to the Vanguard fund family, and I looked at all of the funds that had been around for at least 15 years and that were focused on equity. So I ruled out any fixed income funds, I ruled out any target retirement date funds, and I ruled out any of the allocation funds where, you know, they're trying to have, both stocks and bonds and such in there. I was really just looking at equity funds, whether domestic, whether international, whether large, whether small. And what I looked at was, let's take as a group all of those funds that over the last 15 years, ending February 28th of 2022, had a better 15-year compound annual growth rate than the S&P 500 had. Now, why did I pick the S&P 500? Because a lot of investors will use that or the Dow Jones Industrial Average or something as their benchmark. That's the benchmark, right? That's what we should compare everything to that. I disagree with that, by the way, but nevertheless, because that is a widespread sort of tool that serves as a basis of comparison for many investors, I wanted to use that. And what I found was that there were 13 such funds in the Vanguard fund family that it had a superior 15-year return. And so I took those as one group, and I'll describe what I did next. Then I looked at all the remaining funds that it had, there's only two conditions: you're either better or you're worse. So the other funds that had a poorer return over that same 15-year time frame, and I had 39 in that group. So you can see just by the ratios there, 13 above, 39 below, the S&P 500 during that 15-year window was one of the better things. It was better than 3/4 of the things on this list. And so for a lot of people, when they're developing an investment portfolio, they're thinking, that's the benchmark. That's really not a sort of intermediate representation of a lot of different possibilities. Over this 15-year period, it happens to be a representation of one of the stronger elements of your investment of the universe of investment possibilities for you. So what did I then do? Well, I measured the day by day the trailing performance of each one of those funds. So altogether 52 plus the S&P 500. And I measured that trailing performance on two time frames looking back. One was, how is it done in the last year? And how is it done in the last 3 months? Then what I did the same thing for the S&P 500 as the baseline, and then I compared each of those funds to the S&P 500. So in other words, how did fund XYZ do versus the index fund in the Vanguard lineup on a trailing 12-month basis? Was it ahead or behind, and by how much? And on a trailing 3-month basis, was it ahead or behind, and by how much? And then on average, how was that group of 13, the elite 13, how were they ahead or behind? And the lower 39, were they ahead or behind? So let me show you just what this looks like over time, and then and for listeners that are just strictly listeners and not viewers, what I'll do here is I'll try to explain this in such a way that it makes sense.
Eric, I'm sorry to interrupt. You're sharing your screen now?
I'm going to share my screen. So not quite there, and so here I am sharing my screen now.
And so, a quick summary: you've compared mutual funds that have outperformed the S&P, and you're comparing them now versus the S&P.
Correct. And so the graph that we're looking,
it's percent of outperformance, not percent gain. Correct?
Percent of outperformance or underperformance in relative terms. So they might all be down, but some are down more or some are down less. They might all be up, but some are down, or some are up more, some are up less. So it's using the S&P 500 as the strict baseline, and everything is being measured in relation to that. So what we're looking at right now is of the 13 that had a better 15-year compounded annual growth rate, what you see is that at the average line, and for our viewers, that's the gray line in the middle. What you can see is it's on average, it's not like they're usually just hovering right at what the S&P 500 is doing. On average, they're usually swinging back and forth, 3-4% below, in some cases 4-5, even 7-8% above. In fact, recently the group as a whole was maybe 8% below. So in this case, when you're looking back, and this is just the 12-month now, if you're looking back, well, wait a second, my portfolio over the last 12 months hasn't been doing quite as well as the S&P 500. Let's get rid of this stuff. I'm underperforming. If you had done that in this case, you would have said, wow, you would have jettisoned some pretty strong performers, ones that in the long run did quite well. In fact, look, the blue line at the top, viewers and listeners, I'll describe this for you, is showing what the best of the group, or at least restate that, of the 13 funds, by how much was the one that had deviated most to the upside, how much to the upside relative to the S&P 500 was that fund. And then down below, the orange line is showing how much to the downside was the one trailing the most during that phase. How much was it deviating to the downside from whatever the S&P 500 was doing? Well, you can see oftentimes, I mean, it's commonly the case that you'll have really good funds deviating easily 20% up or 20% down from the S&P 500. And so no one's really complaining, of course, or really frustrated, of course, when something's 20% above what the S&P 500 is doing, 10, 20%. But they can be really, really frustrated if they see that a fund or something like that is on a 1-year basis is trailing by 10 or 20%. And if you on that basis said, I'm going to get rid of this, you would potentially, at least in this case of these 13, have done yourself, in my view, a disservice. But that's more like that 10 and 20% range that I just discussed. That's kind of normal. Even at other times, the extremes can be that something might be close to 40% below on a trailing 12-month basis where the S&P 500 has been a really good fund or a really good investment. So I'm just wanting to say that don't allow, in this, at least the example in this particular graph is, don't allow yourself to have your portfolio plan just derailed and start kicking things out willy-nilly because you see that they're not keeping up in that phase in that one phase with the S&P 500. They might very well be a spectacular investment just waiting for a reversal in your favor. Here's the 12-month. Now here's the 3-month. You can see what's the stark contrast here isn't that the magnitude is greater. Actually, now the normal 3-month divergences are more in the 5 and 10% range, but it's a lot more common. And as a result, if you're using a 3-month return and you're saying, hey, for example, as we're having this conversation in mid-March of 2022, then if you're looking back, let's say even as recently as mid-December of 2021, and you're saying, wow, this particular part of my portfolio is just really, really getting beaten up now. Let's get rid of this. This is a terrible investment. I think just give it a little leash. And especially if we're having this conversation now in 2022, I would say since COVID hit and then the recovery out of that let's say starting mid-year of 2020 until now, the deviations to the downside have been closer to, on just a 3-month basis, 15, 18% in many cases, at least for the worst one among them. So now you might say, well, Erik, that's just because you're focusing on the best ones. What about the worst ones? Maybe the worst ones would sort of reveal themselves as being worse over time. Well, here, when you look at this, it is indeed the case that the worst ones on a 12-month basis have a greater span of deviation than the best 13 had done. But bear in mind that there's 3 times as many elements that are being evaluated here. So here, when things aren't going crazy, it is still the case that the sort of normal deviation to the upside is around 10 or 20%, whereas the normal deviation to the downside is maybe closer to 25, 20 to 30%. But the extremes have been as much as 120%, 125% to the upside against the S&P 500, and as much as, let's say, 70% to the downside. So, I would say here the most telling part about this particular graph, though, is remember these are the 39 that have underperformed. If you look on the far left of this graph, you'll see that for the first, I'll say, roughly 4 years, and arguably maybe the first 6 or 7 years, these funds were really big winning funds. How do we know that? Because their average over that time period was ahead of the S&P on that 12-month basis. These were the strong investing categories. It's only been subsequent to that when it was starting to become revealed that as a group they were losing their edge and actually suffering by comparison. What are some examples in here? International is a big example. It's or in recent years, it's really had, especially coming out of the great credit crisis, it's underperformed significantly since that time. Small cap value, mid cap, emerging markets, and et cetera. When you look at it on the 3-month now, the worst 13, and you look at it on the 3-month, here it isn't quite as sharp, kind of the extreme performance, but it still is the case that there's a lot of 10 and 20% deviation on the upside, and 20, we'll say 15 to 30% deviation of the downside. So I think sometimes the conclusion from all of this, and I'll stop sharing my screen, is I think the conclusion from all of this is that sometimes things they just don't tell you. There's not an easy way to recognize necessarily whether something that's in your portfolio is going to be the home run, or is going to be the big disappointment, or is going to be more or less sort of pedestrian and just playing along sort of somewhere in the middle. And the past history isn't always a great guide, but I would say one of the worst bases for making a decision to exit something, or for that matter, actually even to enter something, is what it's done really, really lately. It's better to kind of recognize that the normal volatility patterns of a lot of the things in which we invest are just that, normal volatility patterns. They are not an indication that whatever's happened the last 3 or 6 months or 12 months, if it's been bad, means that this investment is doomed to lose you money, or the converse, that if it's had a really, really strong 3, 6, 12-month performance, that it's assuredly going to outperform the S&P 500, and you ought to get on board it. The bottom line is, in this at least part of it, while there's certainly room for tactical, and we use tactical strategies, and those are rule-based, not emotion-based tactical strategies. Don't be an emotion-based tactical investor. Use rules for your tactical part. Use discipline for your longer-term buy and hold part. Gentlemen, that's what I had to bring today.
Yeah, I like the conclusion. Let me ask you a question. If you're an investor and you're looking to you own a fund, let's say, just using the example you just went over, you bought it when it was a high flyer. It's now pulled back. What would you use to decide whether you keep it or sell it?
Yeah. So I would impart, well, first of all, let's hope, and I'm going to assume that the investor in this example made the prudent decision to do what we consider to be appropriate portfolio or position sizing. Let me explain what I mean by position sizing. Those elements of your portfolio that have the highest degree of volatility should, in my view, correspondingly have a somewhat smaller allocation. They can still play an important role, but precisely because of their extreme volatility, it's useful, despite their long-term growth rates, to contain the volatility impact that they can have on your portfolio by not allowing them to be beyond a certain share of your portfolio. And so assuming that you've done that, as opposed to backing them up the truck and just loading your entire portfolio into that mutual fund, then I would say stick with it. If it's a reasonable asset class, it's a well-diversified investment in and of itself, then stay with it. In fact, well, especially in terms of if there's good fundamental reasons especially, stay with it. On the other hand, if you went overboard and you just really, really overcommitted to something, you might at that point say, I've learned a lesson from this. I'm gonna scale down my position if the market hasn't already done that for me by a really, really big downturn. But learn the lesson just in terms of position sizing, not to get so excited about a frothy investment to just pour into it. Have a sound fundamental reason for the investments that you incorporate into the portfolio as a whole.
Yeah, I definitely like that answer. Hopefully the position size was done appropriately. And then you touched on exactly what I was thinking. You look at the investment thesis, not the current price.
Mm-hmm.
That was
All right.
an interesting episode. We touched on three, I was going to say completely different, but kind of completely different topics. We lucked out that Erik, yours and I were on different ends, just mine being the Fed and yours being on what I think is very valuable mutual fund holdings and deciding whether to keep them and not to just sell. I think to quote Erik, "Don't sell willy-nilly," was the quote. And Adrian, I really liked how you came up with the stressors, and we got lucky by planning that in the middle and breaking up the two conversations that I think are higher negative stress than positive stress, maybe, if we're talking about Fed movements and prices being down. I love when we have this format. I've gotten good feedback from our listeners. Please let us know what you think of this. Gentlemen, any last minute words to share or anything to add?
No, I don't have about this particular set of topics, but I do want to encourage people, if you're new to the show and you're thinking, well, what do these guys have? We need to, which we haven't done, and we'll make a revision to our website here to have a search component so you can go back and search episodes rather than having to just scroll through them entirely. But we've got more than 100 episodes loaded up on the from this show, and many of them, the vast majority of them, actually also have a video that accompanies them. So if you're thinking, how do I find it? If you just Google the name of our show and then some sort of topic that might be of interest to you, it'll bring up episodes that are related to that. Or you can also go to the best search engine for podcasts on this is listennotes.com. And so you can just plug in the name of our show and then put in some search terms, and you'll find some of the episodes that we've done. So if you have a question, you'll probably find it.
Yep. And thank you for listening. Please, as Erik mentioned, our website, please feel free to visit our website. Give us any feedback you have on there. If you'd like to get some personalized thoughts and ideas on your plan, your financial plan, your investments, you can reach out to us via that website as well. Please like, subscribe, give us 5 stars, tell your friends and family about us. And we're looking forward to being back next week with another episode. This has been the Retirement Lifestyle Show.